Hi, welcome to Bloomberg Intelligence's U.S. Industrials Analyst Call. This is Mustafa covering electrical equipment.
And Chris Cellino covering U.S. machinery.
And Christina Fury supporting Karen Ubelhart, covering multi-industrials and small engine equipment.
All right, first call of 2024. We're running up to the fourth quarter earnings of U.S. Industrials, and we're going to get the views of our analysts. So, Chris, starting with you, when you look at your coverage, your clusters, how are the earnings looking? What are you going to watch for this quarter?
Yeah, if you think about last quarter, we saw pretty resilient performance and broad-based beats pretty much across the entire machinery sector in 3Q with low double-digit earnings growth on average. I think the setup heading into 4Q is not that dissimilar to last quarter. The macro, hasn't materially deteriorated or improved for that matter, maybe with the exception of ag. Consensus is expecting, modest 1 to 3% top line growth. Most of that will be driven by pricing, with volumes falling for many companies. And because we have these extended backlogs, supply chains and factories have largely normalized. We're seeing some relief on the cost side of the equation, particularly on freight, although that may prove fleeting. Pricing, while moderating, is still a tailwind. So we still expect, relatively healthy, albeit decelerating growth on balance this quarter. And I think consensus has 4Q earnings growth, slowing modestly to the high single digit range on average. And that, appears somewhat reasonable to us. I don't think we'll see the magnitude of beats that we had last quarter either. We continue to see pretty strong growth in the commercial vehicle space, particularly PACCAR, Volvo. Partly there's some easier comps there, but build rates are still quite elevated. Pricing remains favorable. Mix should be a tailwind there too. So I would expect a pretty strong drop through before the market begins to really soften over the balance of the year. Construction equipment, that should hold up well too. And I'd expect, again, strong double-digit growth at a Cat and Oshkosh. I think those are the two to watch there. Ag is one area where I think we could see weaker earnings. Crop prices continue to soften. We're, coming off a peak in the large ag cycle. Inventories continue to build. South America is going to be a headwind. Deer flagged some weakness on the ag side last quarter as well. So that's one spot where I'd expect earnings compression this quarter. That being said, this quarter is predominantly going to be about 2024 outlooks. And with many of these machinery markets inflecting after reaching cyclical peaks last year, I wouldn't be surprised to see companies, take a little more prudent approach to guidance, maybe a little more conservative than normal. And really, I think you're starting to see that reflected in machinery company performance early this year, pretty much universally across all our coverage on the U.S. machinery side. Everyone has pretty much underperformed the S&P 500 year to date. We're only a few weeks into the year, but we're down 3 to 5% on average. So expectations aren't terribly high, but obviously any guidance below the street is certainly going to be met with further weakness.
Great stuff. And you've sort of touched upon this. I mean, you mentioned that the earnings beats will not be as strong as last quarter, but when you look at the quality of the earnings that will come this quarter, be it, whether it's volume driven or cash flow generating, how do you see that?
I have a hard time seeing it being volume. I'd expect volumes to be flat to down for most companies. Pricing will be the biggest contributor, particularly on the top line. It's going to come down to more execution, some operating leverage that I think would potentially drive the stronger than expected results. So I don't think this is, especially with all these cyclical markets turning over this year, this is not going to be a volume story. And typically when we see volumes compress, it gets more challenging to drive leverage in the business. So I would expect you're going to see margins come under pressure. But again, this is not a fall off the cliff type of scenario. I think at least for 4Q, things should hold up, maybe not as well as last quarter, but things are still going to be okay. And then the guidance will be, the ultimate driver here of what the stocks are going to do, because most people expect, pretty softer markets throughout the year.
Sounds good. Likewise for electrical equipment. I mean, for the large companies, the Eaton's, Hubbles of the world, we also expect somewhat wide guidance ranges because of the softening macro backdrop. Although in those companies' cases, you also have the stimulus spending ramping up, and the likes of Eaton, Amphenol, they also have good exposure to aerospace, which is still, doing quite well despite all the headline news from, what's happening with Boeing and other companies. With aerospace exposure, that brings me to Maltese. And Christina, we'd like to hear your views on 4Q earnings. So what are you seeing in your space, please?
Sure. Yeah. So a lot of similar themes as Chris has mentioned. 2023 was definitely a year of normalizing for the multi space, and similar trends will probably play out in 4Q that we've been seeing throughout the past year. Overall, top line growth will still be kind of slow. Again, it'll be driven by lower volumes, and pricing will help offset, and better operating leverage will help offset. So all of the price hikes that happened in 2022 and 2023 has really kept margins healthy and will remain robust, even though organic sales will probably be a little slow. With the multis, you're involved with a lot of different end markets, and so those companies more exposed to consumer spending markets or China, like 3M, Johnson Controls, Stanley Black & Decker, those companies are probably going to have worse earnings just because of the weaker demand that's going to get squeezed from those end markets. And kind of similar to what you said, Mustafa, with aerospace, companies like GE and Honeywell and Parker Hannifin that have good aerospace exposure will definitely have a better 4Q because of the big tailwind from commercial aerospace rebounding all year. And the rental equipment companies are definitely benefiting from the federal stimulus, and more of that will come in 2024, which we could talk about the outlook in a minute. But I think this year for the rental companies, 4Q will be more of a normalizing of their used equipment sales. They've been trying to refresh their fleet after the supply constraints in the past couple of years. So it's been a bit noisy of a year for them, especially in their margins. And that will still play out in 4Q, but we think that'll be much better in 2024.
Move on to Chris and ask about individual companies. Chris, you mentioned Caterpillar and Oshkosh sort of standing out potentially, but what are the companies that, machinery investors should be really paying close attention to in the fourth quarter, and what are the reasons why, please?
Yeah, I think Oshkosh is an interesting one. I'd say we're probably most constructive on Oshkosh heading into the 2024. Just as a little background, they're a roughly $7 billion diversified machinery producer. They make everything from aerial equipment. They have a defense business, a vocational business, which makes fire and emergency equipment, refuse vehicles, concrete mixers, stuff of that nature. And they probably have the strongest growth outlook over the next 2 years across our machinery coverage. Their backlog already covers 2024 production. If you think about on the vocational side, there's a self-help story that's kind of in the early innings playing out there. You also have pricing tailwinds in the fire business. Pricing takes a little bit longer to pass through there, so that'll be a tailwind in 2024. And they also recently acquired a company, Aerotech, which is a new vertical for them, gets them in the airport equipment business. And there's an attractive secular growth story there as well. So, and then on top of that, you have the what they still call the defense business, but it's essentially going to become the U.S. Postal Service. They won the contract for the next generation delivery vehicles, which will commence production here in the second half of the year. So a lot of growth tailwinds that are somewhat detached from your traditional economic cycle. So we think the outlook there is quite encouraging. Maybe on the flip side, ag markets have softened pretty quickly here. CNH is one I would maybe call out as just one to watch that we're a little more concerned about as this large ag cycle turns. Inventories continue to build both on the new and used side. The farm economy and backdrop is not particularly helpful moving forward here. So from a cyclical perspective, some of the ag names could see some near-term pressure. And CNH has put together or announced some restructuring and cost actions last quarter. We'll look for more details on that in 4Q, and maybe that provides kind of an offset to some of the softer markets that we're anticipating.
Great stuff. And from my side, I guess the discrete short cycle automation companies, mainly Rockwell Automation and Cognex, they've already seen their orders come down. Cognex has actually seen their earnings and sales have come down significantly as of last quarter, and that should last this quarter as well, we expect. The positive surprise there could be any commentary around destocking, which has been the theme of third quarter earnings for us. If there are any signs of that abating. And the CEO of Dover, which makes, similar to Oshkosh, I guess, a bunch of components and subsystems for different end markets, they mentioned that some end markets, like fueling, they may have destocked too much. So we may see an end to the destocking trend there, and the orders could flatline, hopefully in the fourth quarter. So that's another company to watch as well. Christina, what about the multis? Do you see any companies sort of standing out, or you'll be watching closely in your space?
Sure. So in the core multi-space, 3M is definitely a bellwether for the space. It broadly reflects the economy. They've had a challenging year, and they also have their litigation situation that has kind of been weighing on the stock, but their 2024 outlook and their initial read on the macro environment will be really interesting for investors in the multi-universe to understand what's really going on. They also have about 10% exposure of sales to China, which will also give a good read through how China is recovering. On the equipment rentals, United Rentals, the largest in the group, their outlook for the construction landscape for the year will be interesting for us. American Institute of Architects actually just raised their forecast to 4% of non-residential growth this year, and we still think that could be too low with all of the federal spending that will finally flow this year. So here in United Rentals, outlook will be good. And then finally, Stanley Black & Decker, they've had an internal story the past couple of years, and they're finally making progress in their turnaround. 2024 was a year that they said that they can get back to $4 to $5 of EPS. So their guidance that they're going to put out will be scrutinized to see if they are really ready to commit to that number for investors.
Sounds good. And maybe sticking with you, Christina, and the 2024 theme, do you have any particular expectations from guidance or from any of your companies?
Sure. So like I said, the rental companies, they've had a noisy 2023, and so they've been refreshing fleet. They've been having a lot of large capital spending. We don't expect the CapEx to be as high this year because they finally went through their really old used equipment that they've kind of held during the pandemic because of equipment availability. So their CapEx spending probably won't be as large, but it will be interesting to see how their margins will then shake out because that's been kind of compressed because of all the used sales equipment. The HVAC companies, which I haven't mentioned yet, they've been going through a big channel destocking this year, especially in residential. So 2024 should be more in line with demand, and that's what we expect guidance to come out with. Commercial HVAC has also been still very well demand growth, so it'll offset the residential, which is still kind of stabilizing, especially since the consumer is still lackluster. And the Inflation Reduction Act, it will finally start to have a greater impact on the HVAC companies this year, which will be something that we expect to see in the outlooks. Overall, the multi-industrial space will probably, we expect to have organic growth slower in 2024, and margins are still going to stay robust. So it should be an interesting first half of the year.
For sure. And similarly for electricals, I mean, things are slowing down. At the same time, you have the tailwind from stimulus spending coming in the second half. Um, in terms of the guidances from my space, I guess first of all the ranges will be wide, accounting for slowing economy and all sorts of macro backdrop that the CEOs will use, things like the Red Sea troubles and Middle East questions around raw material prices, uh, freight inflation. So I guess all of that will be taken into account when they give out their 2024 outlooks. Um, More importantly, though, some of my companies are sort of a little bit behind in the capex cycle compared to the rental companies you mentioned. For example, Eaton has mentioned that they're going to spend over $1 billion over and above their usual run rate of capex in the coming 2 to 3 years to expand capacity. There are still some shortages in the transmission and distribution space, which they're trying to expand production for. So the tailwind from smaller working capitals will not be there. There will be some incremental investments. So I'm guessing the quality of the earnings may not be as high as fourth quarter in 2024. So that's another thing to take into account for our space. But overall demand should remain robust, albeit tough comps at a slower rate. So more similar to multis there. So Chris, to wrap things up, I guess what's your expectation from 2024 guidance, and maybe we could take your own views about 2024 briefly as well.
Yeah, I'd probably echo a lot of the comments you made, probably wider than normal guidance ranges. And again, probably a little bit more of a conservative approach, just given the inflection we've seen in a lot of the machinery markets and expectations that, 2023 was a, a cyclical peak, excuse me, for most markets. Um, so that we are anticipating, a softer market conditions this year. I think the big focus is now becomes on the cost side of the equation to help mitigate some of those declines. All indications at this point would point to a more modest downturn across all the machinery markets than what we've seen in prior cycles. We haven't seen anything that would lead us to believe that we're looking at a more severe contraction, but nonetheless, volumes are going to be down high single digits, low double digits in most cases. So again, softer markets, but each vertical is a little bit different. Trucks, we think it's going to be 24 will be a down year, but we expect a return to growth in 25 and 26. Ag probably down for more than 1 year. In construction, probably holding up a little bit better this year than some of the other verticals, but would expect some pressure there. Obviously, we've seen backlogs peak, orders are declining, and I would anticipate they'll decline throughout this year. Inventory levels continue to rise. So, and obviously we have the heightened geopolitical tension and more, I would say, macro caution out there than we did last year. So we'll be looking to hear if there's any signs of orders being deferred or canceled yet. We really haven't seen that much, so that'd be another thing to watch. And then the other thing, any kind of cost mitigation efforts, like what's the downside decremental margin framework for this downturn? Are we looking at kind of normalized decrementals which for machinery guys typically are in that 20 to 30% range? Or are there some puts and takes that would make this maybe a little bit softer cyclical downturn?
Got it. And we should also not forget, I guess, this is an election year in the US and some of the policies may change, although in practice, I guess, that may not be until the next year. But of course, for a lot of our end markets, the IRA is a big driver, and there are some questions, will that be gutted out? Can it be gutted out as well? So I guess that it will also overhang some of the CEO commentary this year as well. Okay, with that, we will conclude our call, and thank you very much to both Chris and Christina for sharing their views. We'll see you next time.